ask the host to give me permission to record. Sorry, so I
Yes,
think
you are.
no, the second one I'm not. But there are two. I'm there twice.
I put it on both. Hold on, Bojan. Oh yes, strange. Oh, okay, you are co-host 2 times.
Okay, so now it is recording already.
Yes.
Perfect, thank you. So are we all good with the interpretation?
Yes. Missing Aaron, so we have not all interpreters.
Okay, so can we start again?
If the interpreters are okay, we can start.
Okay.
Aaron is here, just having been assigned.
Aaron is coming finally. Hold on. Yes. Now Aaron is included as an interpreter.
Okay. Great. Thank you, Jean-Philippe.
I think we can start.
Okay. Thank
Perfect,
you.
Thank you.
Thank you. Very sorry about that. Apologies from us, TCA and UNCTAD. Peter, please over to you. Thank you.
Thank you. Thank you. So I'm going to continue presenting this research, but also as a way of second introduction, given that I have this chance. Let me say that I'm greeting you from Prague, where we have a group of researchers working on estimating illicit financial flows, and there are a number of us focusing on corporate taxation. And you will hear from my 2 other colleagues, researchers, Bathusi and Miroslav, who will have their follow-up presentations in half an hour or so. So this specific paper that I'm presenting today is using a specific data set that many of you are aware of or working with, that is country-by-country reporting data by multinational corporations. And many of you might be using the data in their work, and it's the multinational corporations reporting this data to possibly you or your colleagues in the tax authorities. So using the aggregate anonymized version of the data as published by OECD last year for the first time, that's the data set we are going to be using. We have not updated yet with the data recently released by OECD for a follow-up here. So that's one contribution we're making, exploiting this new data set for as many countries as possible. The second contribution we're using is proposing a specific version of the tax semi-elasticity method. So our second contribution is a methodological one, and it's about a logarithmic function being used to model the extremely non-linear relationship between profits and tax rates. In simple terms, multinational corporations, when they want to avoid taxes, they ideally want to pay as low taxes as possible. So we see this non-linear behavior in the data later. Let me just briefly preview the results, what we find. There are 4 questions, 4 research questions we answer in this research, and these might be some of the questions might be similar to what you might be interested in your work. So what was the scale of profit shifting that most easily overlaps with the Sustainable Development Goal indicator? And the question is, so how large is profit shifting? The second and follow-up question is which tax havens are responsible for the largest share of profit shifting? Third, which multinational corporations are responsible for this profit shifting? And for example, are we able to say whether US multinational corporations are more aggressive than some other, than corporations headquartered in other countries? And the fourth question, and that might be close to your interest too, is which countries are hit by this corporate tax avoidance most? Is it the countries at the with lowest income per capita, or are the high income countries hit proportionately more? So that's the fourth research question that we address in this paper. If you could mute, that would be great. Or if somebody could mute everybody else. Thank you. There's a large body of literature studying profit shifting, and I'm not going to discuss it in detail. And Bojan has covered some ground in his first presentation, and there are a number of papers as well as the book mentioned earlier that do discuss it in very much detail. But I'm of course very happy to come back to discussing policy as well as academic literature if it would be of interest to any of you. Let me now briefly discuss in more detail the data that we use. So we use the aggregated data which are anonymized. We don't have access to data for specific multinationals, but only for a sum of all of them from across many countries. And we see activities of multinational corporations in up to 190 countries. For most headquarter countries, we use 2016 data, but for 2017 only, when we did this version of the research, only for United States, newer data were available, and we use them because they provide a better coverage. The country-by-country reporting data, one of the good things about it is that they are provided for both only profit-making affiliates and both profit and loss-making affiliates. So for example, for estimation of effective tax rates, where we divide corporate income taxes divided by gross income, that's for that purpose, it's better to use usually the profit-making affiliates, because then these effective tax rates are not biased by the loss-making affiliates. But for most other purposes, we use data for all affiliates because that does cover the whole universe of the large multinational corporations covered by the data. There are a number of imperfections of the data, and we can come back to discussing some of them later on or in the Q&A session. But one of them is, and let me be upfront about it, is that the countries reporting the data to OECDs aggregate them to various levels. So many countries, in fact, most countries, did not report any data to be shared by OECD with researchers and with the public. Other countries varied how much detail they provided on the affiliates of multinational corporations that were in their country. So, for example, you can see that Mexico or United States provided information on affiliates present in all major tax havens. In contrast, Norway or the Netherlands have not provided any information on affiliates in major tax havens. So there's a huge discrepancy, a huge difference in how much data we have for various companies according to where they are headquartered. And that's something that in this paper with Javier Garcia Bernardo, currently of Utrecht University, that we do deal with using machine learning and other methods. In terms of the methodology, Bojan in the previous presentation outlined the option very nicely, and traditionally most studies have applied the linear specification. Recently, quadratic specification has been the preferred one, let's say. In this paper, we are proposing a logarithmic specification, but we are providing results for all of them, and we enable a comparison of them. What I'm not going to focus in this presentation on are following two topics, but let me mention them at least briefly, and we can of course come back to them in discussion if that's of interest to you. So once profit shifting is estimated using the tax semi-elasticity model that I will discuss in more detail, you know how much multinational corporations shifted profits to tax havens, but you don't necessarily know from where the profits were shifted. So you only know the scale of profit shifting, you know to where profits were shifted, but it does not come naturally from the tax semi-elasticity method from where the profits were shifted. So you need to make some additional assumptions, some additional estimation. And that is what we call here a reallocation of the shifted profit. And in the paper, we're using indicators of economic activity to establish from where the profits were shifted. And you can use a similar logic, the economic activity, for an additional method that was also briefly mentioned by Bojan in the presentation, that so-called profit misalignment model, where in contrast with the tax semi-elasticity model, it's much simpler and does not reflect tax incentives at all. So in the profit misalignment model, you just compare where activity is happening and whether the profit is aligned with this economic activity. And where there is much more profit reported than, for example, there are employees, then we say that the profit is misaligned in these very often tax havens, and therefore that can be considered, let's say, an upper bound for profit shifting. So this is an alternative method that we apply in this paper, but the focus of this presentation for this workshop is on the tax semi-elasticity method. So let me proceed with the tax semi-elasticity method. We've already seen a version of this equation in the presentation by Bojan, and on the left-hand side, you have profits, and on the right-hand side, you have what are the determinants of these profits and these in theory. So profits could be well explained in line with economic theories, with capital and with labor.
In respect of strengthening demand, and here to reinforce what she did. Presently, we are working with policy alert.
I'm sorry, I cannot mute him.
Policy
Okay.
alert with
Just a sec.
Thinking, because I don't have the, I cannot mute him too. Yeah.
Yeah,
Thank you.
sorry.
So this is the most common model, and it's based on simple economic theories where profits might, in theory, be explained by combination of capital and labor. And the added term in this Heinz and Price model, going back to their paper published in Quarterly Journal of Economics in 1994, is that they, in addition to basic controls, they add a tax rate there. So the tax rate, if it does explain anything, then that could explain the part of the profits booked in any given country that is not explained by the combination of capital labor, and that is the term that can be identified with profit shifting. So what this model is doing, we're looking at in simplicity at relationship between profits and tax rate. So let me now proceed to explain the further specifications. The first one is the quadratic one, where in addition to using a tax rate as an explanatory variable, we also add the tax rate squared. So that is an improvement on the previous methodology, and in fact it was already proposed by Heinz and Rice and used, but it then have been largely unused by the follow-up literature, and it has been again revived by a paper by Timothy Dowd and his colleagues, published in 2017 in Journal of Public Economics using confidential US tax returns data, and they made a very good case why it's the quadratic specification is a preferred one, and I understand that might be mostly considered a consensus among a number of economists writing about this topic. When we look at the data that we have, we're still not sure whether the quadratic specification is enough. It improves on the linear specification, and it does allow for some non-linearity between effective tax rates and profits. But as we can see from this graph, the non-linearity might be more extreme than the quadratic function can allow for. So here on the horizontal axis, we have effective tax rate. And on the vertical axis, we have profit per employee. So that is above here on the top, there are countries in which there is high profitability. And to the left, there are countries that have very low effective tax rates. And as we can see, basically, only countries that have extremely high profitability have extremely low effective tax rates, close to 0%. And this scale, the profitability scale, is in logarithmic scale. So the nonlinearity is really extreme. So a way to account for this nonlinearity is to include, in addition to the linear term, is to include logarithmic tax rate. And that's what we propose, and that's what we do. But in the paper itself, we are applying all the specifications alongside each other for everybody. We make a case for the logarithmic one, but we're presenting results for all of them. And so if you like to use quadratic one, then if that's your preferred one, you can use it. You can see the result. How we explain the logarithmic one? Let me use the case of Jersey, where this on the horizontal axis, I have again the effective tax rate, and here it's the increase in profits estimated from a regression. So we have the regression results in the model, but I didn't think it was useful to show a regression table to you in the slides. But of course, it's publicly available in our working paper. So these are the lines estimated from the regressions that show the relationship between effective tax rate and the increase in profit implied by the effective tax rate. And as you can see, for Jersey, which has effective tax rate of 0.1%, is the increase in profit implied for Jersey differs a lot across the models. So if it's a linear model, then increase in profits resulting from this extremely low effective tax rate would be 2.7 times more for the linear model. It would be 12.4 times using the quadratic model, and it would be almost 300 times for the logarithmic model. So especially for these tax havens which do provide a very low effective tax rate, the choice of the model makes a very big difference. The bigger picture is that if you use linear or even quadratic model, you are more likely to estimate profit shifting as coming from as profits being shifted to countries which have only moderately low effective tax rate, around 10–15%. But if, and that's what we see in the data in the graph that I just showed you, if the profit shifting occurs mostly to tax havens to countries with extremely low effective tax rates, such as Jersey, then logarithmic model will provide a result. Will provide an estimate of profit shifting that that says that most of the profits were shifted to Jersey in this case. So that was the methodology that we applied, the tax and elasticity one. In terms of our result, for all countries worldwide, we estimate that almost $1 trillion of US dollars in profit was shifted in 2016 to tax havens. That implies a tax revenue loss of around $200-300 US dollars annually for all countries worldwide. And this is one of the higher estimates in the literature. Here's a table of estimates that provided results for all countries with available data, and there are around 8 studies, and we provide results for most for the highest number of countries, almost 200 countries. The other studies, which is IMF's Crivelli et al. Or UNCTAD's own paper published in 2018, coming out from the World Investment Report in 2015. And there's also a couple of estimates in the literature from me and my colleagues, including Alex Cobham and Miroslav Palanský, that will be presenting later today from Charles University. So we provide we provide relatively higher estimates, not the highest one. That would be Kim Closing, who is now working at the US Treasury on the global tax reform. Yeah. In terms of the more detailed results, so it's almost 1 trillion in total, but where these profits shifted, to which tax havens, and from where these profits shifted. That's what this graph depicts. Let me explain how this graph works. So on the right-hand side, the red countries are mostly tax havens, so countries, the destinations of profits, where the profits were shifted. And the axis ends with 1, so that's 1 trillion. That's the total figure that we just talked about. And here it says that Cayman Islands, using the logarithmic model, Cayman Islands are the biggest profit shifting destination. And the number in there says that 94% of profits that are reported in Cayman Islands were shifted there, according to these estimates. I have six columns, so 6 methodologies. We've introduced linear, quadratic, and logarithmic specifications of the tax elasticity model. So these are the 3. In addition, we have the results of a profit misalignment model that I briefly discussed at the beginning. And in addition, we have 2 models, two estimates from Dowd et al., the paper mentioned earlier, and we use the elasticities from their model to estimate the scale of profit shifting for comparison. And on the left-hand side, these are estimates from where the profits were shifted. So for every 1 trillion here for the misalignment method, for example, we have 1 trillion of profits from where these profits were shifted. And we can see that the United States or France, Japan, Germany are among those countries that saw most profits shifted from there, most in terms of US dollars. So it's not surprising that some of the biggest economies have seen the highest losses due to profit shifting. It's also the percentage, again, similar as with the tax haven. So for example, the logarithmic model says that 5% of United States profits were shifted to tax havens. Behind this is, of course, more detailed set of results that we have in the paper, where for each of the almost 200 countries worldwide, we are estimating how many profits were shifted from it for each of the methods. So here, this is a summary, something that I can show you and that you can grasp the main results from. And the previous graph showed the results in US dollars. So, you know, the horizontal axis was 1 trillion US dollars, but that does not necessarily paint a fair picture in terms of how much countries are hit by profit shifting. As a measure of that, we propose a tax revenue loss as a percentage of total government revenues. So here we're showing the same results, but we are looking at revenue loss as a share of total tax revenues, the current total tax revenues by the countries in question. And we show the results for misalignment as well as logarithmic models, and we show it in terms of averages for countries at different levels of income and for various regions. For the income categories, we can see that the lower income countries have the highest losses due to profit shifting, and they're very high also for low income countries, and especially so for the misalignment method. In terms of the regions, we can see that the Caribbean islands in North America are some of the biggest, have seen some of the biggest gains. And we can see that Africa, Asia, and Latin America are among the biggest losers on average. Again, this is only showing, this is aggregating the country level results for us to be able to present them somewhat meaningfully in one graph, but we do work at the country level, and for each country, for Brazil or Nigeria, we provide individual estimates on the basis of the data and methodology as explained. So let me sum up the findings from this paper. So the profit shifting scale is bigger than previously estimated, we say, and also this has been partly confirmed by the very recent version of one other influential paper by somebody else than us, by Thomas Torslow, Ludwig Wier, and Gabriel Zuckman, who have a great paper called "The Missing Profits of Nations," and over the years they're updating their estimates, and it's getting bigger and bigger. So they're coming closer and closer to our 1 trillion estimate. So it's good to see that different methodologies, but the estimates are converging to each other. We have highlighted the role of extremely low effective tax rates. So these are the tax havens, these are the countries that attract most multinational corporations' profits. It's those tax havens that benefit most from the profit shifting. We have also shown that low-income countries, and especially in some regions, just Africa, are more hardly hit than other countries when compared with when we compare the tax revenue losses with their current total tax revenues. And something that I have not shown in this presentation, but when we look at the heterogeneity by the headquarters of the country, we show that US multinational corporations are really special in the sense that their multinational corporations avoid taxes using tax havens more aggressively than other corporations headquartered in most other countries that we have data for. So this is a summary of our findings. Let me briefly discuss. I understand that this might be of interest to some of you. Is not the focus of this workshop, but what are the implications for a global corporate tax reform that has been agreed by not all but some countries worldwide? one side of the coin that we highlight is that postponements are costly for low-income countries in particular, especially if the reform should be effective in curbing profit shifting. Then the sooner the better, and low-income countries should not be losing the tax revenues associated with it anymore. We also, with the results that we have in this paper, we also show why a unanimous support is unlikely, if only because some of the major players in the global economy are implicated in the current state of profit shifting. So you have, for example, US multinational corporations being the most tax aggressive. You have some European Union member states being some of the biggest tax havens, such as the Netherlands or Luxembourg or Ireland. And you have also the United Kingdom and its network of overseas territories and crown dependencies that are some of the most important tax havens. So these are some of the reasons why negotiations are going to be always difficult. And if the global deal on minimum tax rate is effective or not is an open question. The fact that there is some agreement is surprising in itself, given these facts about profit shifting. And we've highlighted, that any reform, this one or another one in the works, should address the importance of tax havens with low effective tax rates, and the global minimum effective tax rate has at least some potential of tackling some of the profit shifting. So let me briefly mention, before I conclude, let me briefly mention results from some other papers. So one of my recent papers with Javier Garcia Bernardo and Gabriel Zuckman is addressing one specific problem in the country-by-country reporting data. So we have a paper, working paper version of the paper, this preliminary findings, and we are revising it right now and should be out before Christmas, an updated version. We address the so-called double counting in the country-by-country reporting data. So multinational corporations were not clearly advised on how they should report their income, and there could be some double counting in the country-by-country reporting data. For the United States headquartered multinational corporations, we can address the problem extremely well, and we showed that the extent of double counting in the data is quite big. Why we are able to do that for US multinational corporations? One thing is that the United States provides one of the most detailed data sets on aggregate country-by-country reporting data, but it's also that we have additional data sources for those multinational corporations. We have CompusStat, we have Orbis, these are private sources. We have a number of other data sources from the US government, such as balance of payments, Bureau of Economic Analysis survey. We have a few other data sources for US multinational corporations. By triangulating these data sources, we are able to, with some confidence, to estimate the double counting. So that's one issue I can talk about more. Is a long paper to be shared and discussed in case that was of interest to some of you. Another paper I'd like to mention that we have with a few colleagues, including Tommaso Faccio, Oliver Baron, and especially Sarah Godard, is exploiting the data that some companies publish their country-by-country reporting data. So there are around 10 companies that have decided to go public with the data that they confidentially report to their tax authorities. And so we are analyzing the data using the tax elasticity method and estimating the scale of profit shifting. So that kind of data and that kind of paper, they could be useful perhaps as another example, maybe in some future workshop, to see how the data how the detailed data here voluntarily published by the corporations can be used to estimate profit shifting. Let me mention briefly two other projects that I'm working on and that I published paper on. One is about banks, country by country reporting data, which have been the banks in the European Union have been reporting country by country reporting for almost 10 years now, and so there's a lot of data and experience with it. The data is not detailed as it is for the large multinational corporations we are talking about here, but still it does provide interesting lessons for what we might want to establish with the new data. And it's similarly even longer story with the extractive industries country by country reporting data, because the data have been around for longer, but the data is even less detailed and perhaps even less useful for estimating profit shifting. But I wanted to highlight that something that I'm looking at with my colleagues. So, at the highest level, I think what we've shown in this paper and what I'd like to convey to you is that estimation of profit shifting is possible. Of course, if we would take another half an hour to discuss all the limitations of our estimates in detail with you, and I understand that you as experts, you can see many of them. And also, in this paper, we are providing estimates for up to 200 countries, and each of you is an expert, a very good expert at least one of your country, and you would see why our estimates are inadequate. And that is where I see a great potential of collaboration between researchers, for example, our group based in Prague, Cortex, or with other researchers where we could join forces and arrive at better estimates. And one improvement that can come from better data is that the data that we are using in this specific paper are very aggregate. We don't use data for specific companies. As I understand, many of you might have access to much more detailed data. It would be exciting to work along with you on exploiting these data sets. And my colleagues, Bathusi and Miroslav, are already working with Nigeria to exploit this data to estimate the scale of profit shifting and how profit shifting could be curbed. So that's, I think, I'm looking forward to the presentation. That's a great example. So the country by country reporting data is great. I think we can do better by working with more detailed country by country reporting data, but it would also help to combine it with our data set, as we did for the United States in the paper that I discussed a while ago. So we see great potential with using company level or even transaction level data from government, making use of new years of data. So in a way, our results with Javier are somewhat outdated, 1 year outdated. We have not updated the results yet, but we will do so shortly. And I see, even on the methodological side, there are improvements to be had. So with that, let me finish, and I'm looking forward to engaging discussions with you. And let me repeat, it's a great honor to be with you here today. And I'm glad that we are discussing this important topic of profit shifting and how to estimate its scale using the tax and elasticity method. Thank you.
Thank you, Peter. I'm actually just trying to realize, I think the translation has been lost or interpretation has been lost again. I have no idea what is actually going on, but thank you for your presentation. I don't know if Susan is also still here with us. I was going to ask if there are any questions or comments or requests, since we have Peter here online from many of the participants. So first the question, is interpretation back?
No, it has just disappeared again, just like you're saying.
Okay, although I see now the interpreters
one of my gadgets has had it disappear.
Okay, because for the French, because I see both interpreters back and their channels active. Okay, so I think now it says that it's good. Okay. Well, great. So thank you, Peter. And now I'm please handing
Merci, Peter.
floor over to the participants. If you might be having any questions or comments regarding this presentation, please go ahead. Okay, I don't see any right now, so I know that there will be also presentations following this, but maybe I could just have a quick question, Peter. So you mentioned earlier that for the for calculating the tax rates, you're only taking into account the profit making affiliates. But for everything else, you also incorporate also zero profits or losses. So how do you then essentially, so there was a question earlier this morning, if you may remember. So if we have a logarithm of the profits on the left-hand side, so how do we deal with losses or with zero profits?
I think we'll be using only, if you mean the logarithm on the left-hand side, we will be trying to explain only the countries where positive profits are reported. So, that is, I mean, losses are important, and they have been shown to be used in profit shifting, but in this kind of model, it's you can't. It doesn't make sense, not only because of the logarithm, but otherwise it doesn't make sense to have negative values of profits, losses on the left-hand side, where we're not trying to explain losses with capital and labor in this kind of ones. Okay, but I mean, loss-making companies, I mean, that's one. If I wanted to flesh out the limitations of this approach, it would be the aggregate data do sum up, if you use the data for all companies, they do sum up profit and loss-making companies, and that's a big problem. And having access to company-level data where you could where you could study why the company is loss-making, it would make very good sense, because companies can be or affiliates of companies can be loss-making exactly because of profit shifting, or they can just be loss-making for other economic reasons.
Yeah, thank you. Yeah, no, I think that this is extremely important. And so essentially, using this model, we are addressing only the profits. So we are only observing the units with the profits. So I think the underlying concept comes from the Cobb-Douglas production function. That's exactly right. So positive L, positive K gives positive Y. Okay.
But we see from other data sets that it's not that every company would be profit making and loss making companies would be exceptions. It's up to half companies at any given time are loss making in some data sets. So it is really important, the loss making affiliates. So yeah.
No, I agree. It is. Yeah. Okay, good. I think so. This was the question. I think that was still from before. I think that there might be some other questions that we have left unanswered, but I would prefer that we move ahead and check with those questions.
And I can see one question in the chat, if I may answer it.
Yeah, please go ahead.
The question is, what was it panel data? How many years? So the thing is that it was not panel data. So the country-by-country reporting data was first applied only for the year 2016. So the data published last year in July 2020 was published for the year 2016, when it was not even mandatory for all companies, for example, in the United States. So that was the first year of the data, and so there's no there's no open data set available in terms of country by country reporting data. You have other data sets such as Orbis or Compustat or Bureau of Economic Analysis survey data. They do provide longer time series, but they're limited in other ways in terms of country coverage or the country detail that they can provide. So hopefully that clarifies the issue. So what I presented was based on 1 year of cross-country regression, just to clarify. So, and I can see another question in the chat. Is the CBCR data publicly available? Yes. So there are various country by country data sets available in terms of for banks and extractive industries. There are the companies are in fact required to report publicly. So the data itself is public. What we've been discussing in this paper and more generally maybe at this workshop is the country by country reporting data that is being reported by large multinational corporations that have above 750,000 euro in turnover annually as globally. And for these, it's so-called private country by country reporting. So the multinational corporations are required by laws to report this data, but they do report them only confidentially to the tax authorities of their headquarter country. So the data itself, the very detailed data that companies are reporting to tax authorities, neither companies nor tax authorities are sharing it with me as a researcher as a rule. Of course, as you will hear from my colleagues, the tax authorities can share it with researchers if they want to, and they can learn interesting lessons from it. But as a rule, the data itself is not public. What is public, if the governments agree to do so, the anonymized and aggregate form of the data can be published for all countries that are willing to do so by OECD every year as a part of their tax statistics. So it was the first time it was published in 2020, and there was another version published this summer, 2021 for year 2017. And I can see in the chat that Bojan is now sharing this data that is public and that we are exploiting in the research paper that I just discussed. So it's kind of there are that some data is public, but not all of it. This let me also add for those of you who might not be as familiar with the country by country reporting data as some others. The company is required to report the data to the headquarter country, but the headquarter country can then share the data with other countries in which the company has affiliates. So, for example, if there is a French company that has affiliate in Czech Republic, the company will be reporting its country by country reporting to French tax authorities, but French tax authorities can then share the data with Czech tax authorities, and there are bilateral agreements on sharing the data. Okay, happy to answer any other questions, and happy to engage here in this workshop, or if you want to contact me after the workshop, happy to discuss any possibilities for some analytical or research collaborations. Thank you.
Thank you. Can I just one comment and maybe one question here? I think what Peter has just said is extremely important. So understanding how data, so how and where data are obtained or generated and how they are shared. Of course, the whole purpose of statistical measurement of illicit financial flows is building on the statistical capacity of a national statistical system, which means it is being based on the assumption that national statistical authorities or other institutions within the country would have access to a certain level of data, at the disaggregated at granular level, and they would be able to pull them together and produce nationally owned statistics, taking into account confidentiality issues and everything else. So that's why those data would not be disclosed with anybody from the outside. Now, in some of the cases, those, as Peter has mentioned, research agreements are possible and are taking place, and I think I will be very happy to see in the case study following. Of course, they have not been, put on a regular front, so to say, but these are, I think, important insights and valuable additions to understanding what is essentially going on, not only with the data or the methodology, but also specific to a country that is being questioned. To that end, I think it is extremely important that data exchange in a safe statistical environment within the country, but also bilaterally, so across the countries, is of extreme importance. And country by country reporting data by OECD is definitely one of those steps of moving ahead of exchanging of the data. So this was a comment. So thank you, Peter. Now, just a question. I mean, I think it was Anastasia who asked a question earlier to myself, is adding other variables into the regression. Specifically, she referred to, if I remember correctly, like the debt to equity ratio or asset intensity and other things that might be able to provide additional information on specific, parts that would be describing the units and bringing more into the picture of understanding. So what's your view? What's your take on this? Do you think this would essentially make sense in terms of, econometric approach, but also specifically in terms of understanding or interpreting the results in terms of profit shifting? Thanks.
Thank you, Brian, for both the comment and the question. So I think generally, yes, that does make sense, but let me clarify. I think, if the purpose is systematically estimating the scale of profit shifting, and for such a formal purpose as is the 60.4 target of Sustainable Development Goals, then you need some kind of a process, a unified methodology. For that purpose, it makes sense to have an approach where you can apply to various countries across the board. And so for that, I would not experiment, etc. So I would go with the standard methodology in terms of having profit on the left-hand side. And but I understand you as well as me are interested in other questions than estimating profit shifting for the purposes of the Sustainable Development Goals target. So in that case, of course, I think it's in case the question is, for example, identifying multinational corporations for potential auditing, identifying some red flags, as my colleagues are doing and will be explaining in their follow-up presentation. I think there it makes very good sense to analyze these other data with much more detail, and don't let yourself be limited by this specific form of equation. So I would encourage more detailed analysis, and but it's about the purpose and the appropriate method, so that the two match well each other.
Thanks. This works for me. I hope also for Anastasia. Thanks.
Bojan, would you like to take the question from Lamek? I think there is a hand up. Can you take that as well?
Yeah, I think so. I mean, Peter is here, so let's try and get him all the questions we can. Please go ahead with the question. There's a hand up, yes.
Yes, good afternoon, good morning. My question would be maybe not correctly answered, but it's just something that we should start thinking about. As correctly identified that the illicit financial flows, like what we are talking about profit sharing, if you look at the case of Africa, is that they flow from Africa to OECD countries, as we have seen here or in other articles. But now I also see that the data that we are using to do these estimates are also coming from OECD. Is it now a point whereby you are calling the suspect to do for you the investigation kind of a scenario? How then do we rely on this kind of data set coming from OECD, while we also know that the profit being shifted is going to OECD? Would there be no manipulation, or how then would we test for the reliability of this data? Thank you.
Thank you for your question. You know, if I answered your question in full, my colleagues Bathusi and Miroslav would have no time left for their presentations. But it's a very good question. And let me clarify a few points that hopefully I can clarify within a short time frame. So the data that are being published by OECD are following a so-called OECD BEPS 13 standard. And, you know, indeed, this base erosion and profit shifting was started back in 2013 or so at OECD, only by OECD countries. And so that's why OECD occurs in this time. And it's still the organization that is mostly responsible for coordinating this process. And the process has been extended to include inclusive framework, which includes OECD non-member countries, including most big, let's say, developing countries, including India or China. So, you know, I'm not saying, and there are articles specifically about that the negotiations about these data standards were occurring at a level playing field. You know, I don't want to suggest that, but it has been somewhat better than in some other instances where developing countries are left altogether outside the negotiation room. So there's a standard for publishing the data according, and multinational corporations are reporting to every country, India, China, Nigeria, or United States, regardless of whether it's part of it's a member of OECD. And then OECD, why it's being the aggregated data, why it's being published on an OECD website, is because they have the coordinating role, but they are only taking the data as they receive it, as far as I know, from the individual countries and putting it together and publishing it on their website. So I would not necessarily, you know, there's lots of OECD speaking there, but I think it is following the rules as has been agreed, and then there's not necessarily the discretion. But again, the longer answer to how this process is skewed or not, you know, we don't have all the information and all the time to discuss that. But I would like to, you know, not, you know, it's not that this would be OECD data, you know, it's perhaps a bad label. So multinational corporations have, you know, are required to report data to individual tax authorities, and that's what is important. The data is useful. It was not happening before. It's happening because of these new regulations agreed, coordinated by OECD, and then OECD is then publishing the aggregated data, but it should not take away the usefulness of the CBCR data.
Thank you, Peter. If I can just add a very short thing. So it is true. So these are not OECD data. So these are reported by others. I think it is important to know that, of course, this is not the only source to be used. This is one of the sources that can be used. Of course, in the absence of others, maybe this can be explored. If, however, there are nationally available, more detailed data sources, I think those should be exploited first. In all of the statistical methodologies that we are proposing for the tax and commercial IFFs, what comes first as number one priority is to use nationally available data sources. In the absence of those, or to complement the national data sources, some global or international data sources are to be used. And just to add on the reliability side, what I think is important and what Petr has shown essentially that the IFFs, so we are breaking away from, let's say, maybe a bit of an anachronistic approach to the IFFs. Oh, so there's the profit shifting in the developing countries, so there's IFFs from developing economies or anything. IFFs affect all the countries in the world. From one country they're flowing out to the other countries they're flowing in. So everybody, we are all in the same world. We are all connected in this respect. And if you remember the nice chart that was produced by Petr showing, so the red and the blue ones, it clearly shows. So some countries are, shifting profits out. Some countries are shifting profits in, and they're both on the developed and the developing end. So I mean, how should I point, pointing of fingers, which countries would be liable for something. I don't think this is actually the question anymore. It's the understanding that these flows are happening everywhere. They are just using different channels or taking different forms in different countries, but we are trying to address those with various data sources, including country by country reporting, put at the aggregated form on the OECD website. Okay, so I think with this, I don't see any further questions. I'll just take this opportunity to thank Petr very much for your very well planned and executed contribution. I think it was very useful, and it is also the case study that you refer to is also a case study that we have in the guidelines that we are referring to. So we're very happy to have you on board also for any future, collaboration that we might have as we kickstart the national work in the countries. I propose that we take a short break right now. I would say 10 minutes, and then we continue with Bathusi and Miroslav. I believe that they should be joining us, or if they're not here already. So everybody, let's take a 10 minutes break. We resume at 12 noon CET. So that is in 10 minutes. Thank you very much.
Thank you.
Thanks, Peter.
I hope everyone is back online. So thank you. We'll be moving on to the next session. I'll leave Bojan to introduce our next presenter. Thank you.
Thank you, Susan, and welcome back, everyone. So now we're going to hear from Bathusi and Miroslav. I believe on a very nice example of applying a microdata to evaluate or to estimate the profit shifting by multinational enterprises. So I don't think I should be saying much more or spending any more time on this. So with this, I think Bathusi, if you can, I believe you will be going first. If you can just try and share your screen and log in. Thank you.
Okay, thank you very much. Sharing my screen now. Can you see my presentation?
No, not as of yet.
Okay.
We don't see that you have been sharing the screen. Do you have any problems with that?
Just give me a second. I'm trying to sort it out. I'm using an old version of Word, and sometimes it doesn't appear on the share screen options. Okay, it's here now.
Perfect, we can see it.
Okay, great. Okay, thank you very much, Susan, and thank you very much, Bojan. A lovely afternoon to everyone. My name is Bathusi Gabanatlhong, and I'm a PhD candidate at Charles University here in Prague. I'm going to share with you a presentation on the paper that we are currently working on, and it's titled Enabling More Efficient Auditing in Developing Countries, Profit Shifting by Multinational Corporations and Transaction Level Data. And the paper is authored by myself, Javier, Miroslav Palanský, and Paulinas Iyiga. I have structured my presentation as follows. I'll firstly go through the introduction and move on to the illicit financial flows. And I'll also share the data that we have used for this paper, our empirical strategy, and also some findings of the pilot study, and then move on to implications for policy. And lastly, I will look at the proposed policy interventions. As you are aware that multinational corporations engage in illicit financial flows through profit shifting by exploiting existing tax arbitrage opportunities. As Bojan indicated earlier, they take advantages of the tax differentials. They shift profits from high tax jurisdictions to low tax jurisdictions that are sometimes called tax havens. And the overall scale of profit shifting and the resultant tax revenue losses, they are economically significant. And profit shifting, it has the negative effect on economic growth as it undermines countries' capacity to mobilize its revenue resources. And the question is, which countries are likely to be affected more? Well, my colleague has already answered that question, but just to buttress on what he has already said, as you can see on my right-hand side, the lower income countries, they lose more revenues as compared to higher income countries in terms of, as you can see that tax revenue as a percentage of total tax revenue and health expenditure, it is the lower income countries that are losing more. And then there is a study by Tax Justice Network where they indicate that on an annual basis, we lose around 427 billion. And out of that 427 billion, 245 is due to the corporate tax abuse by the multinational corporations, and 182 is due to the private tax evasion by the wealthy individuals. I mean, this is a significant amount of money that it's sufficient to enhance the infrastructure, human capital, and also to finance debt. As you know that most of developing countries, they have high debt levels. And now moving on to the illicit financial flows by source. Well, the illicit financial flows, we can define them as the illegal transfer of money from one country to another. And the main challenge of addressing this illegal transfers has been the difficulty for countries to identify where the highest risk for financial flows are and like which partner countries are relevant. Basically, which channels and trading partners pose the greatest risk to IFFs. Just to give an example, let's say you do a trade with the Cayman Islands, which is the largest global contributor to financial secrecy. The most important question here is, how is it important to your country? Let's say your country is North Macedonia or Angola. How important are they for your country? And what data sources exist to answer these questions? We'll get back to that in a few seconds. The basic intuition here is that illicit financial flows, they are enabled by legislative opportunities. One, it's secrecy, where there is a refusal to share the relevant information with the legitimate bodies that are needed, let's say the tax information. And also when there is the lax legislation, which also provides motivation and opportunities for corporations and individuals to escape or tax or other regulations. And financial secrecy, it's very harmful, and it comes in different forms. One of the common forms is the plain vanilla Swiss style banking secrecy. That is where a banker would promise their clients that will not share your information with anyone, that is information in relation to your banking details or money available in your account. Sort of will take your secret to the grave. And one other example is where a certain jurisdiction would permit the creation of a corporation, and the ownership and purpose would be kept secret. And now, okay, I can hear an echo. Can you please mute your mic?
Sorry, but I'm trying, just a sec.
Okay. Okay, it's okay now. And now moving on to the vulnerabilities to IFFS. What is vulnerability? Well, vulnerability, it captures how harmful is the secrecy provided by a country's partner in terms of, let's say, the trade, investment, or the banking partners. And it reports the average of secrecy scores of partners with which the country trades or invests for a given weighted by the value of the flow. Here it's a snapshot of the vulnerability tracker that is developed by the Tax Justice Network. Below there is the link that you can visit if interested. If you go to the website, you can find that there is something like, if you look at my right hand side, you'll see information appearing like that, where you can select the channel that you are interested in. Let's say as the inward direct investment, you can select direct inward investment, and then you can also select the year that you're interested in, and you can even also select your own country. And then you'll find information like the lost revenues on annual basis as a percentage of tax revenue. And still on the North Macedonia example, let's say you have selected North Macedonia, and information like this will come up, and this information will show that, as you can see, it shows that most of, or the majority of the FDI entering North Macedonia comes mainly from South Africa, Austria, and you can also see that countries like the UK and Greece, they also play an important role. And now the data sources that are available. We have the macro data and the micro data. What I've been discussing earlier was the macro data, which is at country level. And in terms of the channel, we're looking at trade, FDI, the bank or portfolio. And we are, in terms of intensity, we compare it with GDP. And then the main goal behind it is to understand the vulnerabilities and also to target policy. The macro one, it's at firm level. And then in terms of channels, it's transfer pricing transactions. And then we compare with revenue or gross profit. And the main goal behind the use of the macro level data is to identify those red flag transactions or companies for audit. Macro data, it's also a good data source that has been widely used in literature, but then the main problem was that it's one, illicit financial flows, they do occur at some level, and then it doesn't give us an opportunity to better understand the specific behavior of individual companies. And in terms of macro data, several literatures they have used the Orbis database. I know there was a question earlier regarding which data sets have been used in literature. The Orbis database, which contains the financial information of the private companies. But then the main problem with this data set is that it's limited in terms of coverage, mostly the low income countries and the tax haven. And that is where we come in now. We are proposing a new source of administrative data. And this data is called the transfer pricing disclosure form. In short, it's TPDFs, and I'll be using that a lot. The TPDFs form, they are submitted by all active MNCs in a country, submitted to the tax authorities on annual basis. In other countries, they started submitting them in 2019, and others it's earlier than that, but they're submitted as part of the OECD BEPS program, Base Erosion Profit Shifting Program. And as you can see, that is a snapshot of the TPDFs. They contain information on control transactions and the value of those control transactions. They also contain information regarding the location and the classifications of those transactions. When we receive the form, we receive it in anonymized form. We don't even know the names of the company. We're not interested in that. It also contains the basic financial information of the company. We receive it in this format and then we digitalize it by hand. And for the purpose of the study, we managed to obtain access of the administrative data in Nigeria on 278 transactions worth 115.9 billion US dollars. And that amount was made by 37 individual companies that have filled the TPDFs correctly. Now moving on to our empirical strategy. Our strategy, it consists of 2 steps. And the first step, for each category X of transaction, let's say the royalty fees, between the affiliates companies I there, we calculate what is called the hypothetical total tax paid on the transaction value, that is the TIX, which is defined as the sum across X and C of the products of the applicable tax rate TXC and the value of the transaction category XIC. Let me just go back a bit just to say that this data, this TPDF's data, we use it to estimate the relevant importance of the transaction categories, namely the tangible goods, service and fees, royalty, and others listed there. And then from there, we move from the transaction level data to the company level data, where we now use our TIX, which is the hypothetical taxes, in the variation approach pioneered by Hines and Rice 1994. You know, the earlier the presenter also mentioned this model, and Bojan also presented something similar to this. And as you can see that our TIX is an explanatory variable in a regression that it's used to explain the reported profits of affiliate. So I'm not going to spend more time here because the second presentation, we are going to go in details to discuss our model and then the data, and also share some of the regression results and show you how to interpret them. And now in terms of the results, when you look at figure 1, which shows which transactions are most often directed from or to aggressive tax haven, you can see that most of the interest payments are made to countries with the highest haven score. I hope you can all see that. Yeah, it's they were made to countries with the highest score, haven score of 76.4. And here, as I mentioned earlier, that we only have access to the administrative data in Nigeria. It means that our sample is very small, which means this limited sample does not enable us to do a more detailed econometric analysis of the individual channels. And in terms of the destinations, if you look at my right-hand side there on figure 2, you can see that most of the interest payments were going to the Netherlands, Mauritius, UK, and Bahamas. And now moving on to the implications for policy. In Nigeria, we analyzed a sample of 87 companies. And from there, we created a risk profile for each company, which was based on the value of the transactions and the location of the subsidiary. And that risk profile was created to help us to identify the high-risk companies, that is, the companies that are likely to engage in profit shifting. From there, 6 companies were selected to be audited. The 3 were using the old methodology, that is the World Bank methodology, which focuses on the abnormally high or low financial ratios. And then the other 3 was using the vulnerability analysis. And those audits are underway and are expected to be completed soon. And in terms of the proposed policy intervention, it's in 2 phases. In the first phase, we're going to identify companies that are likely to engage in profit shifting, the so-called high-risk companies. And in the second phase, we'll send letters to a randomly chosen subgroup of companies. And then a year later, we'll then analyze the TPDF's forms just to assess whether there has been a change in behavior in terms of corporate tax paid and reduction in profit shifting. And here we argue that this policy intervention is an effective tool, as it will help most of the developing countries to better audit their multinational corporations, to maximize the revenue collections, and also to reduce the profit shifting behavior. Concluding my presentation, as I have already indicated, we use the administrative data from Nigeria, and we intend on adding more data from other countries to improve the robustness of our results. And that administrative data, we use it to identify the relative importance of the individual channels, and also to estimate the scale of profit shifting. And we are happy to help you to use your own administrative data to identify the transactions that are most often used by multinational corporations to shift profits out of developing countries, or by the wealthy to hide their assets and evade tax and other regulations. And from what I have shared with you, it is evident that the interest payments to affiliates in low tax countries, they emerge as the most likely or important channel of profit shifting for our sample of the Nigerian companies. And as I have already mentioned, we have another presentation where we are going to share in details our methodology, share some regression results, and show you how to interpret them. Thank you very much.
Thank you, Busi, for that presentation. Quite enriching, and it answers a lot of questions. We have a question from Eunice. I don't know, maybe you could quickly respond and then we go to the next presentation. It's in the chat. It says, how about middle-income countries? Most of the world's economies are middle income. Maybe you could take that quickly and then we'll go on to the next presentation. We'll take the questions after this presentation. Thank you.
Okay, the question says, how about middle-income countries? Most of the world's economies are MNEs. The focus here, yes, it's on developing countries, because that is where, I mean, most of the existing literature that is available, it focused more on developing countries. So the gap is more on the countries that are still developing, and that is where our interest is. Okay.
But you see, then I think that's sort of a nuance you're going to have to add, because there are middle-income countries that are developing countries. In your slide, the emphasis on high-income countries and low-income countries. So ergo, then it means that somewhere middle-income countries also have to feature. So maybe you want to change the language from high income to low income, because then it will generate the questions on middle income countries. So if you want to focus on developing countries, that might be the literature, the conceptualization that you use then.
Thank you, Busi. Thank you, Eunice. We'll go straight into the next presentation, which is very ready. This is by Miroslav, manipulating the data and running the regression. Thank you. Over to you, Miroslav.
Thank you very much. Good afternoon or morning. And yeah, so my name is Miroslav. As has been mentioned already, I work at the Charles University as a researcher, and also as a data scientist at the Text Justice Network. So most of the work that we're presenting on today is part of the Text Justice Network's efforts to mitigate illicit financial flows. And just to maybe add to Bathusi's answer and to the question by Eunice, thank you. That's a good point on the wording. The methodologies that we use and the data that we use can be used in any country, in theory. The reason that we focus on developing countries or lower income countries is just a classification issue, right? But is that there is not so much research on these topics in developing countries, because the data is usually not available, and that's sort of one of our contributions, that we work with the available data in these countries and sort of take the methodology that exists and fit it onto the existing data there. So what I would like to do in the next half an hour or so is to take you through a concrete application of the methodology. I'm going to be using Stata and showing you the code. I hope that it's a fairly straightforward exercise. So I'm going to be explaining what is happening, and you will be seeing the code and the results and the data that underlie it, so that you can see how you can go from the hand-collected transaction level data that we have from Nigeria into some concrete estimates of text semi-elasticity. So let me share my screen now. Okay, can somebody confirm that you can see?
Yes.
Perfect, thank you.
Go ahead, thanks.
Okay, so this might be a little bit technical. I hope not so much, because I have tried to comment on the code a lot so that we see what's happening, and I'm going to be going through it step by step and showing you the data as we go along. But if you do have a question, please do stop me just by unmuting your mic and jumping in if I should explain something more. Or if I should go faster.
Yeah, someone is saying, can you share the code?
Yes, so this is the working version of our research. We have it up on GitHub, but we don't have it yet shared because it's a sort of working version. We will be developing this in the coming weeks and months, so I can easily share with you the version that we have now, and then you know, just so you can see what's going on. But unfortunately, it's not yet final, so it will be up online when it's final. Okay, so Just to walk you through the chapters, so I have created here a little collapsible buttons that can collapse the individual sections of the code. So I'm going to be using that once I go through the code. I'm going to collapse it so that we have some sort of overview on the code. But the first one is just to set up folders and paths to files. So this is an easy one. It will depend on your path in your computer. So I just set some global macros here so that I don't have to write the whole path. And then just use these macros here to refer to files. Okay, so that's an easy one. So I'm going to collapse that. In the next section of the code, there is some more preparation going on before we dive into the data. So here, this section is called prepared data. That will be, and I'm just going to collapse these so it doesn't give us too much detail that is unnecessary at this point.
Sorry, Miroslav, we have interpretation simultaneous in French and Portuguese. Maybe you could slow down a little bit for them to pick some of the.
Okay. Okay, sorry. Okay, so in the next section of the code, we prepare the data that we will need later in the analysis. The way we do this is we have a master data file that has country level information. So we call it country base, where it's basically a file, and I'm going to start and load it. It's a file where you have the country name, you have the year, and some country information. So we have the ISO codes, GDP, different classifications of the country, and so on. So we have all the data that we might need on country characteristics in this file. And on the next line, we keep only certain variables that we will need in the analysis. So here you see that I'm keeping the country ISO codes, the country name, the ISO 2 code, and some specific variables. This is the Haven score from the Corporate Tax Haven Index in 2019, and some data on GDP. And I'm going to save this file as isocodes.dta. So that is a file that I will only use later to have the country characteristics stored somewhere. Okay, so I'm going to collapse this part of code, and let's go to the next one. So in this next part of the code, we dive into the data for the first time. So the section is called import hand collected transaction level data, clean it, and add additional data. So as Bathusi has mentioned, in Nigeria, we work with data from the transfer pricing disclosure forms. And these are hand collected because they are stored on paper in Nigeria, at least the historical versions. And so we hand collect it by basically looking into the forms and transferring the data into Microsoft Excel. So we end up with a file that I'm going to import here in the first part of the code. So let's execute that part. Now, when I check the data, you see that these are individual transactions. So we will have this transaction specified by a number of things. The first one is the company name. So we see that this is anonymized, some ABA Limited company. This is just a code name for an actual company. We have the type of transaction. So we see that this is a reimbursement and it's a cost, not income. So we have different categories of costs and incomes. So these are transactions.
Hello. Yeah, I think we've lost Miroslav. He froze. Maybe there's some technical issues on his end. Okay, but Bathusi, do you maybe have a direct connection to Miroslav?
Yes, I do. Let me send him a message to check if it's okay.
Please, thank you.
So Miroslav is saying he should be back within half a minute or so. He's working on it.
Perfect, thank you. Okay, so then I propose that we just stick around and wait for Miroslav to resolve the technical issues. Thank you. Okay, so he's back.
Okay, sorry about that. Something crashed.
Yeah, please go ahead when you're ready.
Okay, can you see the screen again?
It should be coming up in a minute. Yes, we do. Thank you.
Perfect. Sorry about that. So I'm not sure where I got lost, but we are looking at transaction level data from companies. So we have certain companies that make transactions of certain kinds. Okay, so this is a reimbursement cost that is going into the United Kingdom. It has this value. So I think it's 326 million Nigerian naira, I think it is. And we have some company level information as well. So when we look at just this ABA Limited, you see that all the data that is related to this company is this, right? These observations are related to company ABA Limited. Now you see that there are two different partners that this ABA Limited company had. One is in the Great Britain, GBR, and one is in Ghana, GHA. So we observe 2468 transactions made by ABA Limited. We also have these the transaction type called total, which is important because this is then doubled, right? So we have the reimbursement cost and we have the total cost. So you see that these are the same because there is only one transaction classified as cost. And so this is the data that we start with, that we collect. So you might imagine in your own practice, in your own work, that there might be similar data available to you. The crucial so that you are able to estimate this tax semi-elasticity methodology is the value of the transaction and the partner country. So you have to see how much money is going where. Okay, so those are the two crucial parts that you need. In theory, if you have these two parts, you can implement the IFF risk methodology using the data. Okay. If you have more information about the companies, so such as the gross profit of the company, revenue of the company, the effective tax rate of the partner country, and so on. So if you have this additional information, then you will be able to estimate more nuanced picture. Okay, so I will be showing you how we use these company level information. Also, if you have information about the individual transactions, so such as this is a cost, this is a reimbursement, so you can then differentiate between the effects of individual types of transactions. So that's also what we do in Nigeria. Actually, the goal is to estimate the tax semi-elasticity for different types of transactions. So the objective of this exercise is to estimate the relative importance of individual types of transactions for profit shifting behavior by multinational companies in Nigeria. Okay, now let's go back to the code. And so we have imported this data into the memory of Stata. Now let's wrangle a little bit with the data. Let's work with it. One easy edit is that the transaction field, this variable called transaction, had some spaces in it. So this is a practical issue. If there is a space or a forward slash, we want to get rid of those. So basically, I'm replacing the field transaction by tangible goods, so no space, if there is a space in the tangible goods entry. The same for service fees. So I'm simply removing this forward slash, which will, because we will be using this field later, and it will not be, it will not work if we have these. So that's a sort of practical issue that you also might face with cleaning the data. The next step is to generate a few new variables. So one new variable that I'm creating here is called type transaction. I am combining the type of transaction with the classification of the transaction. So if we go back to the data, you can see that the type is cost and the transaction is reimbursement. So I'm just going to be combining these two to have a variable that identifies the transaction as a cost reimbursement. So just again, a simple edit to the data. We will need this variable for reshaping the data set later. So this is again a practical edit. Here we generate the next one that we generate is called tax, and this is a very important one. It relates to what Bathusi has said in her presentation, that we calculate the hypothetical tax payment on a transaction. So we take the value of the transaction and we multiply it by the tax rate that would have been paid on that money. So the whole idea is, let's say there is a cost to a multinational that operates in Nigeria, a cost meaning an outflow of money. So imagine that this outflow of money did not happen and the money would stay in Nigeria and would be reported as profit. Then what would be the payment of tax on this money, on this profit? Okay, so had the money stayed in, then it of course would not be illicit financial flow. It would stay inside Nigeria, and some tax would be paid on the profit that would be generated from this money. Okay, so this is an important variable that is part of our methodology. Now, the next step is to transform from the Nigerian currency to US dollars, just so we can compare this to GDP data and some other, just transferring from one currency to another. Again, if you work with data from multiple countries, for example, this is very useful to transfer it into one currency. So simply generating the value in USD millions by taking the value and multiplying by the exchange rate, which was, I think this is the average for the year 2020 from which the transactions come. So we take the exchange rate and then we divide everything by millions so that we have the unit of observation is United States dollars millions. We do the same for the hypothetical tax payment and for the revenue of the company, which is another variable that we will use. In the next step, we label the variables that we've created now. So just to have it in good order, the data, because we might use these variables in the outputs, in charts, in figures, and in tables, in regressions, and so on. So it's good to have them labeled nicely. So we create the labels: value of transaction, hypothetical tax payment, and the applicable effective tax rate in partner country. In the next step, we are almost done. One last thing that we would like to do with the transaction level data is that we merge in some additional data. So this comes from the first step that I was showing before. We are joining the existing data set using this ISO 3 code. So we have the ISO 3 code in the transactions, right? The GBR and Ghana and Singapore. So we would like to know more about these countries. Okay? We would like to have that in the data set. So we take this ISO code and we join it with another data set that we created before. It contains some information, some country characteristics about those countries. And we are done with the transaction level data for now, at least. So we save it. We save the transaction level data, and we can take a look at it. Here. I execute the whole thing and then look at the data. So basically what we have done is here on the right, we have created some new variables. Remember, so the type transaction, the combined classification of that type of transaction. We have the hypothetical tax payment, and we have the US dollars values. So we have the value of the transaction in US dollars. We have the hypothetical tax payment in millions of US dollars. And we have the revenue of the company in millions of US dollars. Okay, so this is ready. Let's go back to the code. The next step is, this is the crucial step, because in this next one, we move from transaction level data to company level data. So to implement the tax semi-elasticity methodology, we need data at the company level, not at the transaction level. So we will be doing some reshaping of the data set. So we will prepare some variables first, then we will reshape the data set, and we will generate some further variables that will be done at the company level already. So let's load the data set. So we have the transaction level, that's what we start from. We clean it a little bit. We don't need these three variables, so we just drop them. Those are combined into the type transaction variable, actually, and the A was just the identifier. So A is just a number that we will not need anymore. And these two we have combined into that one combined variable. So we will not be needing these anymore. So we can drop them. Then the next step is to generate summed variables. So we will sum up a couple of columns. And we will do this by type of transaction and by partner country. Sorry, by company, not country and company. So to do this in Stata, we use this command by sort, and we will be generating the variable by these two variables, the company and the type of transaction. So for each company and each type of transaction, we will generate a new variable called sum tax USD million, in which we will sum up the individual observations of that variable. So let me execute this and show you in the data what it did. So where is it? Sorry, I have the controls there, so I don't see company. Okay, let me run this again. Oh, here. Okay, so we see that for the first company and the type of transaction. So we see that there is this new variable called sum tax USD million. And we observe that for that company and that partner country, we observe this value 206. So this is a sum of two variables. Can I hide this? Perfect. The 206 is a sum of these two, of the two values. Okay, so we see that for one company, AAL in this case, we had two transactions of the same type. One was into Nigeria and one was into the Netherlands. We see their values, so we will sum these up, and expressed in US dollars, they give 206. Okay, so here this is where we are moving sort of from the transaction level data into company transaction type. Okay, so basically taking, let's say there are 5 transactions of the same type made by the same company. We would like to sum them up, okay, to go to that more aggregated level. We do the same for the value. So we did this for the hypothetical tax payment, and we do this for the value of the transaction. Okay, so let's execute this. And in the next step, we will drop unnecessary observations. So we are now looking at a more aggregated level, and you will see that there are some duplicates here. That's normal. That's what was intended. So for each company and type of transaction, we would just like to keep one observation. Okay, this one is now obsolete because it's the same. So we want to delete the duplicates in these two columns. Okay, so if these two columns are have multiple observations, we would like to just keep one, because that's already the level that we are looking at. So let's drop these unnecessary observations using the command duplicates drop. If there are duplicates of these two variables, we will force it to be dropped. Okay, so this is data language. We will then only keep some variables that we need at this point, because some of them will now be unnecessary. So what we keep is the company level and the type of transaction level. So all the variables that we created now, these summed ones, we will keep. And right, and so sorry, this is a mistake actually. It should be like this. So you see that we are keeping. Let me rearrange so that it's clearer. Maybe here. We are keeping only certain variables. The first one, the first group is the company level. So we want to keep the name of the company and the revenue of that company and the gross profit of that company. And we want to keep, for some types of transactions, some information, the value of the transaction and the hypothetical tax payment on that transaction. And I will also order it by this so that it's clearer. And now looking at the data, this might paint a nice picture. So we have certain companies and we have their information, revenues and gross profit. We also have the type of transaction. So we have the cost dividends here, and we have the hypothetical tax payment on these transactions and the value of these transactions. Okay, so we have all we need. And now we want to reshape to company level. Okay, so there might be cases in this data that you have two transactions for the same company. If I sort this, so you see that for this company AAL, we now have all this information. So we have their revenue and the gross profit, which of course does not change across these observations because they are for the same company. And for this company, we have the different types of transactions. And this of course changes because the value is different for each type of transactions. So we see that for company AAL, which had the revenue of $914 million, it had this gross profit, that this company has had an income from tangible goods of this value, 914 USD million, and the hypothetical tax payment on this was 136. Okay, so if we go back to the code, what we would like to do is now to go to the company level. So for each, what I mean when I say go to the company level is to have one observation per company. Okay, so we now had multiple observations per company, and we would like to have just one. And what we would like to have is all these values in specific columns and not in individual rows. Okay, so we need to reshape the data set like this, so going from the long version to the wide version, and we would be at the company level. So here the command is to reshape the data going to wide. We need these two variables. For these two variables, though, these two variables are the ones that we would like to keep. in the columns. And so if I execute, let's see what happened to the data. Oh, sorry. Okay, never mind. Sorry about this. There was a mistake that will take some time to sort. So I'll just, for the purposes of this presentation, I'll show it like this. Okay, so what we ended up with is data at the company level. So every company has one row, now one observation. So we have this company AAL, and for this company AAL, we have the hypothetical tax payment on cost dividends, hypothetical the value of the payments of cost dividends, hypothetical tax payment on cost interest, the value of cost interest, hypothetical tax payment on other costs, and the value of other costs. Okay, so for each individual transaction type, we have these two variables. Okay, the value of the flow and the hypothetical tax payment. What we wanted to end up with, company level data. One company has one row. So you see that we have 37 companies, and they either did make some transaction of that type or they didn't. So if there is missing data, it only means that the company just didn't have a transaction of that type, okay, in that particular year. Okay, and at the end of this data set, we have some company level information, the revenue, and the gross profit. Okay, so we now have everything we needed for the company level. We also create some, we generate some additional variables, like we would like to have some of these in logarithm. So we just create the logarithm variables. That's easy. We're also generating this variable called profit margin, which is just the gross profit over revenue. So this is again at the company level. And then we are done with wrangling the company level data. So we save the data set. We call it company level data final. Okay, so that was the main part, the core level data. Now we are creating some analysis from this, right? So if I want to go to the tax semi-elasticity method, then I use company level data for that. But just to show you what is done with the transaction level data, Bathusi has had a slide, I think, on this one, which is creating a horizontal bar chart of countries where interest costs have gone. Okay, so we're looking at one specific type of transaction, and we are looking at where this money is going. Okay, so if there is a transaction specified as interest, and it's going away from Nigeria, that's what we are interested in. Where does it go? So we show this on a bar chart. This is, I think, what you have seen in the slides. Okay, so we have a bar chart of the total value of outgoing transactions classified as interest in USD million. Okay, so we have here the Netherlands, Mauritius, United Kingdom, the Bahamas as the countries where most of the money that is classified as interest is going. So again, done by multinational corporations in Nigeria by the 37 companies that we are analyzing here. But the main focus of this workshop is on the tax semi-elasticity method, and that is done at the company level. And so let me show just the regression that we have done using the company level data. It's quite simple. We just load the company level data. We are labeling some variables here, nothing special happening, just to have it nicely labeled. And then we are running the regressions. You see all around these est commands. Those are used to generate nice tables out of the regressions. So if you have ever worked with data, you know that the regression output will look. Why is this a mistake? Let me run this again. I've ended somewhere in the middle. So the output from Stata is from the regression is like this. So we have run a regression that had the logarithm of the gross profit as the dependent variable, and we had the value of the transaction of the total cost as an explanatory variable. So we are trying to explain whether there is a relationship between the value of outgoing transactions and the gross profit of a company. Okay. Now, this is already similar to the tax semi-elasticity method, but even more similar is when we include the hypothetical tax payment. So as you have seen in Bathusi's presentation, the tax semi-elasticity method is saying when there is a country to which money is going, and that country has a lower tax rate than my home country, then companies will move more of their money to those countries to save on taxes, right? These countries are these partner countries are usually tax havens, and so companies are shifting profit to tax havens by transferring the money there. So that is exactly what we are estimating by this method here. So when you look at this output, we have the hypothetical tax payment. Okay, so what would be the taxes paid on the money if it hadn't gone out of Nigeria? Okay, that's this variable. And we're trying to use this variable to explain the reported profit at home. Okay, so out of this code, running these regressions, we have 6 of them here, and then we export them into a LaTeX format so that it looks nice, and it's a sort of table that you will find in a paper. So here is what that table looks like, the output of this exercise. So here the table 2 in that draft of the paper is called results of the regression of transactions and the hypothetical tax on these transactions on reported profits. Okay, so again, the dependent variable is the log of the reported profits in the affiliate's home jurisdiction. So in this case, it is Nigeria. So we're looking at the reported profits in Nigeria by an affiliate, and we're looking at what explains it. Okay, how can we explain this variable? This variable, and we find that here this positive estimate. Again, this is done only on a very small sample of companies, but you see that when we add this this variable here, this explanatory variable, we see a statistically significant positive relationship between the hypothetical tax that would be paid on the costs of that company on the reported profits. So basically, this is saying, the interpretation of this is that if there is a company that transfers lots of money to countries that have a low tax rate, it will report higher profits at home. Okay. So this is on costs. We have the corresponding estimate for income, which is the other way around. Although this is not statistically significant, that this is what we would expect, sort of. So on income, so money incoming, there is a negative relationship between the money that is incoming and the reported profits. Okay. So that was a short introduction on how we work with the transaction level data and how we can transfer it, reshape it, or aggregate it into company level data, and then use it in the tax semi-elasticity methodology. Okay, are there any questions about any of this?
I think they want a question. I don't think it's a question from me, but just a question of if you could make this data available. And I think most of us would be keen to play around with this syntax, and I think it's the best way for us to really get acquainted with how best we can work with this data. So I hope when you're done with the cleaning, please do share. Thank you.
Yes, we will. No worries. And I think we can, Bojan, I think we can then even set up additional meetings where we can go through this. I'm happy to explain any of this in more detail and share some more code. So every specific use case of data. So if you have different data, then of course the code will look a bit different. We will have the same core, so the same idea, but it might need additional cleaning or additional merging of new data, depending on the type of data that you work with.
Yeah, I think this is essentially, so today's session is more of a, okay, so let's see how things could be done. But of course, there's, I mean, very specific cases in different countries, data availability or any other circumstances. So when countries we really move ahead with the actual application, there will be, of course, more concrete and very technical questions, but I think that this is a very good presentation and a very good, you know, just getting an idea how to go around it. I think there was a hand up. I just don't see it right now anymore. Was there any question? Yeah, yes, there is. Please go ahead, Said. Yeah.
Em português. A minha dúvida é em relação aos resultados da regressão. Tanto reparei, em primeiro lugar, boa apresentação, tanto muito informativa, muito técnica, mas deu para perceber que estes resultados, esse trabalho de estimação do método de elasticidade é um pouco mais complexo, porque requer mesmo o conhecimento de técnicas de regressão e, sobretudo, o conhecimento do uso do pacote estatístico como o STETA ou outro pacote qualquer. Mas a minha dúvida é a seguinte. Reparei que alguns resultados, quando foram apresentados, os resultados da estimação da regressão, tanto os poucos conhecimentos que tenho sobre a análise de regressão, reparei que muitos deles são insignificantes, estatisticamente insignificantes, né? Tanto do ponto de vista global como do ponto de vista das variáveis individualmente. Então, queria saber isso aí, qual é a interpretação disso? Continuam a ser validados esses dados quando eles são estatisticamente insignificantes? Essa é a dúvida que eu queria colocar. Obrigado.
Yeah, so in this particular case that I showed, we have a very small sample of 27 companies that have reported some transactions in the last year. It's a pilot study. The fact that it is not statistically significant is very normal. Statistical significance needs many more observations to be present. So I think in this particular case, it is because of a small sample. Of course, it can also be because companies don't shift profit into tax havens. That is very well possible. Maybe the coefficients will be not so strong, so that the behavior of multinational companies is not so aggressive that you can see it in the statistical analysis. That is an empirical question. You'll need to work with the data and see which individual types of transactions you will find statistically significant and which you will not. So for example, you can find that some of the transactions types, such as the ones that are most routinely used for profit shifting by multinationals, will be statistically significant, whereas other variables will not. So if there is a type of transaction on which it is really hard to use it for profit shifting, then we might expect that there will not be a statistically significant relationship. On the other hand, if you're looking at some transactions such as interest costs, so the debt shifting channel would be captured by this variable, then you are likely to find statistical significance there. But again, it's an empirical question, and it will depend on the particular cases. I also see in the chat that a question whether we can use bootstrapping if the sample is too small. I generally don't think that for authorities themselves, the samples will be too small for a statistical analysis because, usually they possess a lot of data. Of course, the constraint might be that the sample is small because it's costly to transfer it into digital versions. So, such as it was in Nigeria, it took us some time, to rewrite the transaction level data from the paper form into a spreadsheet. Bootstrapping, generally, yes, could be used. I would suggest not try and not to use bootstrapping for small samples. Because, of course, the explanatory power of a small sample does not increase if we bootstrap it. It does increase when the sample is relatively large, but the population is huge. Okay, so let's say we were looking at individual data of on people, and if you have a country with 50 million people and you have data on 5 million, then bootstrapping is a very useful exercise. But when you have 400 companies and you observe only 27, then the bootstrapping within the 27 would not work as well as in larger samples, if that makes sense. So yeah, whether the sample is small or not will depend on the ratio to population, but also the sample size itself. So with 27 companies, bootstrapping is not really an option because the explanatory power of the 27, even if we use all of them, is already quite small. I hope that makes sense.
Yeah, regards. Thank you.
I think we have time for some more questions. If there are any questions, comments?
So maybe from my side, just to reiterate a little bit and talk more about the uses that are possible. So I've shown you an example on one particular country, on a very small sample in a pilot study, on one very particular type of data. But what we can do with the IFF risk methodology that Bathusi has presented in more general is the possibilities are huge. So anytime that there are data on this individual level, so transactions or companies, and you have the data on the financial flows, so cross-border transactions, and you know where they're going, you can do some sort of IFF risk analysis. Okay, the possibilities are very much there. And so I'd like to reiterate, if you have any such data, please do get in touch. We'd be happy to help you use these tools or work in collaboration, in order to work to mitigate illicit financial flows. The data on illicit financial flows is scarce in general. There is no direct measures of illicit financial flows. This methodology of the IFF risk assessment is a sort of indirect look at the data, right? If you are looking at a transaction, you don't know if it's legitimate or if it's illicit. What this technique helps you do is to identify with some level of probability that this might be more risky as a transaction than some other transactions. Okay, so if there is a perfectly normal, from the global point of view, financial flow from one country to another country, none of which act as a tax haven, then the risk is very small. If there is a big transaction out of, let's say, Nigeria into the British Virgin Islands, then it's a very risky transaction from this point of view, because there is likely to be an illicit component of either profit shifting or some transfer mispricing, in general, illicit flows. So yeah, we'd be happy to engage in any sort of collaborations or and so on.
If I may just add here, I think what Miroslav just said is, I think, crucial. specifically when we apply those types of methods. So, by definition, we are observing, we're trying to observe or hunt or estimate the unobserved part, which of course makes it extremely impossible. I mean, those two words maybe not work well together, but yeah, you know what I'm saying. So the thing is essentially that having some sort of complementary information. So in terms of risk assessment that Miroslav was mentioning, or results from some other methods, or experts or expertise on a specific multinational enterprise in specific sector, for instance, these would all have to come at play when we are trying to understand and then estimate the IFFs in a country. So I think this is very important to be keeping in our minds, and also not to rely solely on the results. When we get the results out, we say, "Oh, this is it." We always have to validate it. Do they make sense? In a general overall feeling. I think. So the method, so the procedure that Miroslav has presented is slightly different than the method that we propose in terms of how to actually come up to the estimates. I think, as has been mentioned, each specific country with specific data set will drive a little bit the procedure, although the main idea is essentially the same. So we're trying to observe there's a tax incentive to shift profits, and we're trying to estimate how much of that is leaking. Therefore, I think specifically for those methods that are in their early stage in terms of statistical measurement, a lot more collaboration, a lot more discussion, a lot more common work to be addressing those in the coming future. And I think that's why it is very important that we have essentially trainings like this today to then support nationally started or led projects on estimating the IFFs. Okay, so I think with this, Susan, I don't know if you maybe have some, I don't see any other questions, but if you want to maybe come in with some final remarks. Yeah.
Not really, just to say thank you, Miroslav. Thank you to our participants, colleagues who have stayed with us all through these hours. I have been sharing the link for all the presentations we now have in French and English. So please visit the link.
Okay.
Muted, sorry. So please visit the link, download the presentations, familiarize yourselves with them, and also prepare for tomorrow's sessions. Thank you very much. We start tomorrow at 9 again.
Yeah, if I can just add, so this is essentially only the beginning of the journey. So, we will be in touch. You have seen the presentations, you know who to get in touch with, who are the main authors in this field. So hopefully this was a useful today, this sessions for all the participants. I would like to thank our presenters, so Petr, Bathusi, and Miroslav, for your time and your valuable contributions. I would like to thank the interpreters and all the IT support. Unfortunately, we had some of the challenges, but we were able to overcome them. I'm going to share in the chat a link to the evaluation or feedback survey. So I'll be very happy if you could take a minute or two to respond to those questions. You will see that there is one form for English and Russian, and there is another form for French and Portuguese. Unfortunately, with the Portuguese translation, we are still waiting for the final words to come in. So we should be having those maybe later in the day. But the forms are there, the links are there, and we'd be very happy to receive your feedback. With that, I think, Susan, I think we can conclude. So thank you all again, and I wish you a wonderful afternoon. Stay safe.
Thank you.
Bye-bye.
Bye.
Thank you. Bye.
Take care, everyone. Cheers. Okay, on the technical side, so Jean-Philippe, are you there maybe? Okay, I think we
Hello?
can. I think we can.
Walk through the technical issues. Okay.
Yeah, so I think we can just stop our recordings right now.
Okay.